Good morning. We're here to talk about Silicon Valley real estate market geographically, as well as the Greater Bay Area, 13 counties in Northern California. I'm Richard Calhoun of Creekside Realty. We'll get back to this slide at the end. Here is a new slide. This is showing the monthly payments. And one of the key takeaways for me were a lot of the people were blaming the slowdown in the marketplace that we experienced in 2022 on the increase in interest rates. So what I plotted here was what the payment was on the typical median priced home for the geographical region using a 30-year fixed mortgage with an 80%, 20% down payment, 80% mortgage. And the payments actually were going down in all 5 regions at the period of time that the market was slowing down. It was not an affordability issue that was causing the slowdown. And you can see that in some areas like Santa Clara County, payments are now higher than they were at the peak of the marketplace. In San Francisco Marin, the payments are still lower. If you go down here to the Central Coast, the payments are higher. If you go into the North Bay, the payments are basically the same, depending on what part of 2022 you're comparing it to. And in the Central Valley, the payments are essentially the same. I just thought that was an interesting slide, and it clearly shows that in 2022, payments in the early part, the second quarter, basically when the market was really slowing down, payments were dropping. So the slowdown was not payment related. Here's a summary of what we're going to be talking about. We start off with DUI, days of unsold inventory, one of the key indicators, in my opinion. Closely related is days on market for the 75th percentile of the sellers. We're going to not have the list price to original list price for this week. Unfortunately, I had an error that I couldn't get corrected in time. We have the frequency of overbidding, so very related. The frequency of price reductions, very low numbers. The lower the number, the hotter the marketplace is. You can see a lot of these are in single digits. That basically says, for example, here in Foster City, only 9% of the sellers take any price reduction from the time they go on the market until the time they accept the offer. Here's the overbid. This is when the buyer comes in. How much are they overbidding to ensure they get the house? You can see we're in the low, just over 100%, 105%, 107%, 101%, less than 110% for the most part, and mostly over 100. The one exception for not being over 100 is the expensive areas in San Mateo County at 99.8%. This is the frequency of overbidding. Vast majority of them are between about 66% to 75%. There's some a little bit lower, like in the expensive areas in Los Altos and Palo Alto at 45, the expensive areas in San Mateo County at 41. Also, South County, which is Morgan Hill, Gilroy, San Martin, is down at 41. Then you have the appreciation since 2015. It's the last 9 months. The higher the appreciation, the redder the color, the lower the appreciation, the bluer the color. And then finally, the price range, the 10 percentile, the median price range, and the 90 percentile. And then we'll go into each one of those. Here we're starting off with the days of unsold inventory. You can see geographically how it's spread out. The San Mateo, Santa Clara County border is sort of the epicenter, the job center, the epicenter of the real estate market. With COVID, people could flee the work center and get a more house for their money. And so the hotter marketplaces have been in the more outlying areas, which is not typically what we've experienced. Here's DUI over time. You can see that on the right-hand side here, we're pretty red. We've been pretty red for a while, but you go back to the beginning part of the year and we were pretty pale, which would be a much slower marketplace. DUI is sort of the speed of the marketplace. It's the turnover rate. Days on market, 75th percentile. This is sort of the long typical seller. So a seller that comes on the marketplace isn't able to sell immediately. How long is it taking them to sell? And basically they're around and under 3 weeks, between 2 and 3 weeks for the most part. I consider anything from under 3 weeks to be a red hot seller's marketplace. Anything from 7 weeks and above to be an ice cold buyer's marketplace. Between 3 weeks and 6 weeks, 3 to 6 weeks would be a sort of a balanced marketplace. So 21 to 48 days is sort of that, reasonable time frame. 48 days is a month and a half. If you sell your house in a month and a half, most people would be pretty happy with that. Right now, most people are selling their house in about 2 weeks, which is clearly a fairly fast-paced marketplace. Here's the price reduction. I am pretty confident in my numbers. I wasn't able to get the geographical map up here for you, but it's the same order, and you can see the price reductions on average they're pretty much in the 99 percentile range. And anything from 98 to 99 and a quarter is a ice cold buyer's marketplace. And you might say, wow, that's not very much price reduction. And that's because the vast majority of the sellers do their homework before they put their house on the marketplace and don't have to take any price reduction whatsoever. So on average, when you put in all the people that aren't doing any price reduction, a 2% price reduction is pretty significant. And you can see for the vast majority of these, the only area I'm seeing that is lower than 98% is the San Mateo County coast. It seems like I'm very aggressive in the number, but I looked at the data and try to use benchmarks that made some sort of sense based on where we've been for the last 25 years. Here's the frequency of price reductions. How common or uncommon are price reductions? The redder the color, the more uncommon a price reduction is. You can see a lot of these are in the low teens, fair number are in single digits, but again, sellers for the most part just simply don't take price reductions. They price their house correctly from the beginning, and then they just stick with it, and they're selling their house fairly quickly. You know, it's maybe not a good benchmark to see, but I'm trying to give as many benchmarks as we can, and I think I come up with reasonable numbers, even though they may seem very aggressive. The magnitude of overbidding, this is the sale price to list price ratio on average. So it includes the buyers that come in and underbid a seller's asking price, and as well as those that are over. You can see almost every area is over 100%. Again, the only exception I'm seeing is the San Mateo County coast at 99.8%. And again, you can see the outlying more affordable areas are in general doing better. You can see the affordable areas up here in Alameda County, being the city of Alameda and the city of Oakland, are actually doing some of the best numbers at 113% and almost 116% for Berkeley as far as the average overbid. So on average in Berkeley, buyers are coming in at 16% above the seller's asking price. This is the frequency of overbidding. This is how common is the buyers to overbid. Up to 1/3 of the sellers getting overbid is considered by me to be a buyer's marketplace. You might think that 1/3 of the sellers getting over their asking price is pretty aggressive, but when you go back and look at where we've been in the last 25 years, you'll see that we rarely go below 33%. And basically, I don't think I've ever seen a number below 15%. Then on the other side, you have to get over half the sellers getting above their asking price before you get into what I consider to be a seller's marketplace. And we've been as high as 95%. Here's the appreciation. I'm using the last 9 months of 2015 as my base mark, and I'm looking at the appreciation since then. Technically, you have to subtract off the 100 in front. You've had 88% appreciation. You're 1.8 times the value of the home was for South County from 2015. You can see the more affordable outlying areas, the areas that are harder to commute in from, are the ones that have seen the most appreciation. And that's because for the most part, those are the ones that have seen the most appreciation recently, most likely because of COVID. The areas that are close to the job centers have seen the least appreciation, again, because of the shift away from job centers. Here's the sold price. I have 3 numbers, and the color is assigned by the median, which is the middle number, and that's what most people follow. I add in the lowest 10 percentile, so you get a lower number, as well as the upper 10 percentile or 90 percentile to get a sandwich. You can figure out what the price range is in every geographical area. Now we're going to go through a monthly and then a weekly distribution. I'll let it play out, and then we'll describe it as we go. Basically, as the line jumps down, the market's depreciating or slowing down. As it goes up, it's improving. Each line is the sale price to list price ratio for that given week. And it starts off at months from 1 year ago to 3 months ago is monthly. And then from 12 weeks ago to current day is weekly data. So now we're well into the weekly data. You can see you sort of have a large plateau here with a little bounce. And what's interesting is this last week and this week, you've had a jump up, and next week you're jumping up pretty good. So it looks like we're having another improvement, even though this is about the time of the year where the market's sort of almost at its apex. The 5 weeks before Memorial Day typically are the best. Now we're changing over and doing the same thing with the overbid. So this is what the buyers come in and do. So you start a year ago, then a monthly down. So the market's going down right now because there's less and less overbidding. Both arrows is a plateau, so a little plateau there, down more, another plateau, and then we're going to turn around and start climbing up. So that's where we are now. You can see the last couple of weeks have been fairly constant on the amount of overbidding. Now what we're looking at is number of active listings. And I've added the numbers over on the right-hand side, and I thought that might help people to get some idea when they're trying to compare. Unfortunately, when the data is close together, the two numbers post on top of one another, and I just ran out of time today, so I wasn't able to physically separate those. In the coolest marketplace, where you tend to have a lot of inventory, we had 3,000 listings. And right now, on the hottest marketplace, you've had, I think the number is 1785, and right now we're at 1788 if I'm reading those numbers correctly. But we're having one of the least amount of inventory that we've had in the last 10 years, at least the least amount that you would expect. And the expectation is set on the 10 percentile. This is the median where you actually expect the market to be up here at 25, almost 2,600 listings. So we're 1,000 listings short of where you'd expect it to be. And the worst you'd expect it to be is up here at 3,200. Same concept, but now flipping over and looking at offers. The number of offers coming in is basically right at the record low of where you'd expect it to be for the last 10 years. We have to pay a little bit of attention because that's going to come back later and not necessarily make a whole lot of sense. And I'll explain that when we get there. Now, the median number of offers accepted is 3,000. So you're only selling about 2/3 of the number of offers you'd expect. The most offers you'd expect is up here at about 3,300 offers in the 5-week period of time. And I also want to point out too, these are actually offers that are accepted. And a lot of people that are reporting data, because that's what the industry does, is they report listings on pending. I think pending statistics is very misleading because what they're doing is they're looking at what's happening to escrows that are pending currently. And if a property comes on the market and it's all cash and closes in 3 days, it's pending for a very short period of time. And if another property comes on the marketplace and has a troubling loan, is in the escrow for 90 days, it counts for a much longer period of time. So it skews the data. There's also many other factors with it. And I look at just the offers accepted. Every offer is accepted at a given day. And I go back 5 weeks. So I look at the number of offers over 5 weeks. A much better analysis of the marketplace from, I think, any objective point of view. Here's your days of unsold inventory. So the lowest, fastest paced market you'd expect is down here at 27. You'd expect to be right around 30, and that's where we are right now. And again, the coolest you'd expect the market to be is at 41. So you can see there's not much range from 27 to 41 days, and where you'd expect it to be is 30, which is exactly where the market is. This is days on market. This is a little bit easier for a lot of the lay people to understand. It's how long does it take the typical long seller to sell. Quickest you'd expect them to sell is 12 days. Right now you're at 16 because the purple is below the gray, the median. The typical is 17 days, and the slowest is 20. In the last 10 years, sort of the slowest you'd expect the market to be at this time of the year is 75% of the sellers would sell in 20 days. And again, this is for Silicon Valley, Santa Clara, San Mateo, and Alameda counties. And now you're looking at the average ask price reductions. And again, your numbers are right now are both 99.4. Yes, the scale is so large here that the two numbers are readable and showing the same number. But if I put up the more significant digits, the top number would be higher than the bottom number, and that's why they're posted that way. The blue is the lowest you'd expect it to be. The purple's where we are. Number-wise, you're identical, but you're a little bit slower or a little bit better on the purple. The typical is 99.6. The hottest we've ever been is 99.8. You can see the ask price reductions is a very condensed number where the difference between the best you'd expect and the worst you'd expect is only 0.4% of price reduction. That's why my scale is so condensed on that particular data point. This is the frequency price reductions. The hottest marketplace, only 7.7% of the sellers take a price reduction. Typical market is 9.7. Where we are right now is 10.5. The coolest marketplace, you'd only expect 14% of the sellers doing a price reduction. The coolest we got was just end of the year last year, and December 2022. Only a third of the sellers were taking a price reduction. So you can see that it's not common for sellers to take price reductions. This is the average overbid. Same concept. The slowest the market's been is 104.5%, which is almost incomprehensible when you think about it, for buyers to come in and consistently pay 4% above the asking price. But again, this is at this time of the year. You can see that there are times of the year when you get down to very close to 100%, but never are we below 100% for where you'd expect the market to be. Currently, we're at 106%. Typical is 106.8%. The hottest we were at is 113%. 15%. And again, that's for this time of the year. You can see that you do have a year that exceeds the hottest you'd expect, and that's because the hottest expectation is the 90 percentile, the coolest marketplace is the 10 percentile. So there is room to outdo that. This is the frequency of overbidding. How common is overbidding? The coolest you'd expect is 62% of the sellers to get overbids. The hottest marketplace is 84%. The typical is 73%. Right now we're at 67%. The market's sort of funny right now. It's a fast-paced marketplace with a lot of overbidding, but the magnitude of overbidding isn't that high. This is the sell price on log paper, just my sort of freehand best line, which is sort of the constant rate of appreciation. And you can see we're getting right back up there. In the 3 counties that make up Silicon Valley, right now the median price is $1,545,000. You can see we were quite a bit higher, somewhere up around 1,750. So we're still $200,000 below where we were on a median. This is the number of active listings for the 3 counties. So now what we're doing is we're looking at breaking up Silicon Valley into the three counties: Santa Clara County in the blue, San Mateo County in the burnt orange, and Alameda County in the gray. So San Mateo County is the smallest county, and it has 424 listings. But one of the things that may not be so obvious is if you come back here and look, that's right in line with where it typically is at this time of the year. But if you look at both Alameda in the gray and Santa Clara County in the blue, somewhere around 700 listings, 660, 700 listings. But look how that compares to where they normally are. They're normally up here somewhere around 1,400 listings. Those 2 counties, which are much larger than San Mateo County, only have half the listings that you'd expect them to have. And that's why when you put them in a blender and you add in San Mateo County that has a number of listings you'd expect it to be, you have about 2/3 of the inventory that you'd expect for the whole Silicon Valley. Offers accepted, same concept. San Mateo County is smaller, down here right at 400. And maybe you could say that you normally expect somewhere around 550 offers accepted, so it's down about 150. If you look at Alameda County, it's at 800. Maybe you'd expect down around 1,200, so it's off by 1/3. And Santa Clara County is at 890 basically, and again, you'd expect it to be somewhere just shy of 1,200, maybe 1,175. A fairly significant reduction in the number of offers accepted. Here's your days on sold inventory. It looks like Santa Clara County in the blue is the fastest market at 27.8 days. Alameda County is the second at 28.7, and the slowest county is San Mateo County, which is not typical, is at 37.5. In fact, you can come back here and look on the left side of the graph and see San Mateo County is normally one of the fastest counties. You get up here to March of 2020 and the announcement of pandemic, and it shifted and it's come out on the back end as the slowest county. And I think that's all this remote working. And so someone's belief on how successful remote working will be in the long term might dictate where they want to purchase real estate to get the most appreciation. This is the 75th percentile days on marketplace. You can see that Santa Clara County is the fastest at under 2 weeks, 13 days. Alameda County is next at 16 days, just over 2 weeks. And San Mateo County is approaching 3 weeks at 19 days. Here's the magnitude of this list price reductions. And again, you can see that they're fairly close together. San Mateo County is having the biggest reductions of 0.9%. And again, people may argue that this isn't a very good benchmark when it doesn't move very much. The huge advantage of looking at sellers taking price reductions is you don't have to wait for escrows to close. You can see shifts in the marketplace earlier. For example, you come back here and we look at the shift in the marketplace in 2022, and it clearly happened by April 1st. If you look at sales data, it happened, it looks like in May, but this data also shows you that for most of the first quarter, you were fairly flat. So the market was plateauing while most people were under the impression the market was going on a rocket. It's important to get that leading indicator, and that's why I'm focused, or at least giving it equal treatment, even though it may not be an ideal metric because it's so sensitive. Here's the frequency ask price reductions. So you can see Alameda County is the lowest at 9.6%, followed by Santa Clara at 10.6%, and San Mateo County is the most reduction of price at almost 13%. And again, you might say 13% isn't a significant number of sellers doing price reductions, but remember they've done a lot of homework to price their home correctly to sell it for the most part. Here's the overbid. So this is where buyers come in, and you can see Alameda County really shines. It's at almost 9% above the asking price. Santa Clara County is at almost almost 5%. And even though I've been talking about San Mateo County being slow, it's almost at 4% overbid. So sellers on average are getting more than their asking price. This is the frequency of overbidding, the range from 62% to 74%. Again, it's Alameda County that's on the top. Santa Clara and San Mateo County are fairly close, with Santa Clara outperforming San Mateo. Here's the appreciation, and because the appreciation is greater in the outlying areas right now, San Mateo is doing the worst on overall appreciation, but Alameda County and San Mateo County being a tie at 166%, and Santa Clara, sort of the heart of Silicon Valley, being the winner at 85% appreciation, so outperforming by 20 percentage points. And if you start going, 60% appreciation, 20% more, it did a full 1/3 more appreciation, which is pretty unusual for that kind of discrepancy. And you can see that normally they're on top of one another. But again, where did the shift really come in? It might have started back here, but it's sort of noteworthy here in 2022 at the beginning part of the year, where it just pulled away from the pack. Here's the median sold price. You can see San Mateo County is the most expensive at 1.9 million. Santa Clara County is not far behind at almost 1.8, and then Alameda County at just over 1.2. And I like log, and I put in the horizontal so you can come back and you can see, for example, that San Mateo County is right about where the price is for 2021. You can see Santa Clara County is quite a bit above their 2021 pricing, and Alameda County, even though it's strong right now, is actually below their 2021 pricing. And this is the same information on regular paper for those that prefer. This is the new table that I put out there, which just shows payment over time. To me, the biggest takeaway on this, again, is the decrease here in 2022, when people were saying the slowdown in the marketplace was driven by the increasing interest rates causing an affordability issue. Well, people were paying significantly less in July and in June than they were in May, and yet the market was slow. That sort of debunks that, which basically says it was something other than the increased interest rates that caused the market to collapse. Now, maybe the interest rates helped increase the amount of the collapse, that I can't argue, but something other than the interest rates, because interest rates are payments, job security would come into this, in my opinion. If you're going to be potentially losing your job, you're not going to be willing to take on the payment. So even though the payment's lower, you're not willing to make the plunge. Thought that was just interesting. I don't know if I will continue this graph long term or not. It's also interesting to see how stable the payments had been for a long time, even though prices were going up, and that was because interest rates were going down. And if you look in Santa Clara County, your payments were getting lower and lower every year as your house prices were appreciating. This now is looking at the actual numbers for those that like to see the numbers. The number of new listings is fairly constant. Active inventory picked up a little bit, which is not atypical. In fact, typically the most number of offers is accepted the 5 weeks before Memorial Day, which is just a week away. The most inventory is usually around July the 19th. So the fact that we're up, it doesn't surprise me. The number of offers accepted is going up. With now you can see Alameda County actually went down. You have each one individually as well as the combined aggregate over here on the left. Days of unsold inventory increasing in Alameda County. Still 29 days is pretty aggressive, but a 3-day increase is sort of surprising. My normal rule of thumb is you pay attention when there's 5 days, but a 3-day increase is sort of noteworthy. It stood out for me. I caught it. The number of closings, days on market, median. I like the 75th percentile, a fairly new benchmark. You can see it's somewhat related to the average. Average is not a good benchmark in my opinion, because if you have one property that's been on the market for a year and sells, it brings up your average. It would not bring up your 75th percentile. So your 75th percentile becomes more stable. Your price reductions the seller takes, the over or under bidding from the buyers, the appreciation since 2015, the 10 median and 90 percentile, and also the appreciation since 2020. And you can see Santa Clara County has really appreciated significantly more than the other two counties since 2020, as well as since 2015. Here's the numbers for Silicon Valley single-family homes only, but the big takeaway is if you look at the number of offers here at 917, about the only year that is lower or about the same order of magnitude, and it is actually even bigger, was 2020 when we were coming out of the complete shutdown of the pandemic. And we'll get to that a little bit later for all of Silicon Valley. And likewise, the number of closings down here, 766, 583, that's still got the pandemic impact because of looking back. And here is for people that like to compare apples and apples. The first slide was May data, which isn't available until June the 5th. We're not there yet, so I used data through midnight last night for this year, so it's not a complete apples and apples comparison. This is, but it's backwards looking because you're looking as of May the 6th. Here is the number of record low volume of offers accepted, and this is for Silicon Valley. And the pandemic is actually still the record low number. Okay, it's 2014, 2085, but I think everyone will admit that's an unusual year. It's there so you know the record low, but what I wanted to do is be able to calculate the percentage of the median and percentage of the low based on reasonable data. So I'm ignoring 2020 in calculating these percentages. Out of the last 10 years, excluding 2020, sort of out 9 out of the last 10 years, we're only selling 78% of the homes that we normally have. Now that's improving. You know, we were down here around 55, we were down around 65, 63. If this trend continues, it looks like the volume is returning a little bit, which is actually encouraging. Then if you look at the 25-year period of time, which, you know, again, it's 24 out of the last 25 years because I'm ignoring 2020 from April 5th onward. But again, you know, you're somewhere up here around 78%, 83%. You're really not changing that much. So when you look at a longer time frame, the percent drop isn't as much, but it's more stable. It isn't showing the improvement that we're showing in the last 10 years. It is interesting, and I might want to check my data, but I think it's just a coincidence. You're both identical here at 78.5%, which is, you know, a statistical chance because just the week before everything looked like it was going normal. I'll try to look at that. I'm not aware. I didn't see anything in processing the data, but I didn't notice that until now. Here is where you look at the 3 counties and you compare everything to the normal. If you were completely normal, you'd be on this horizontal black line at 100%. Purple is your inventory, so you're down here at 69% of the inventory you'd expect. Then you have the number of offers accepted at 69.3%, so 0.3% higher. And then when you look at the DUI, which is the ratio of those two numbers, of course, you're going to be close to 100%, but then the math works out to 98.4%. You have a little bit faster marketplace than you typically do, but we have dramatically less offers than we expect. You know, the only time in the last 10 years that we've had this kind of low number was in 2021 and very early in 2022, basically coming out of the pandemic. That might have been a inventory constraint because everybody was buying everything as much as we could, and you just had no inventory. So the inventory is down, your DUI is down, which is record high, and now your DUI is almost normal. The thing I guess that's interesting is the inventory. Inventory right now, which is the only reason I think the market's as fast as it is sellers aren't going on the marketplace, and that may change if and when prices get up to higher than they were in the first quarter of 2022. So here's a summary of what we went over. I don't think I need to repeat anything on that. And now we'll shift gears and leave Silicon Valley, which was Santa Clara County, San Mateo County, and Alameda County, and we'll move into the Greater Bay Area, which brings in the city, San Francisco and Marin, the North Bay, the Central Valley, and the Central Coast. And we'll go reverse order. We'll start off with the data. Here you can pick up whatever your favorite metrics is and look at it. You can see frequency of price reduction is lower in Silicon Valley than the other regions, but it's pretty small across all the different areas. And in general, Silicon Valley is doing better than any one other area pretty much across the board. One notable exception to that is appreciation, where you have some of the more outlying areas being the Central Valley and the Central Coast actually doing essentially as well as Santa Clara County and better than either Alameda County or San Mateo. And again, I believe that is related to the shift in job commuting practices since the pandemic. So here's the Greater Bay Area. You can see that inventory is normally much higher in all regions, and they've come down. In fact, this outlying areas, the inventory has come down the most. You know, I don't know what number you want to pick, somewhere around around 4,500, and now you're down here at 1,500. You only have 1/3 the inventory. I was talking about Silicon Valley, Santa Clara County being 2/3 the inventory you'd expect. That more outlying areas are only 1/3 of the inventory you'd expect. Moving on to the number of offers accepted, it's all pretty straightforward. I have a little cleanup here because I don't have every data point showing, but I'll work on that. But I thought it was nice to have actually the numbers show up here. In Silicon Valley, you had 2,100 offers accepted. In the North Bay, you had 2,000. In Central Valley, 1,750. Down here in San Francisco, San Marin, 464. And in Central Coast, it's going to be less than that. If I was have to guess, maybe 375, but that's just a guess because I can't pull it up. Same thing for days of unsold inventory. Normally, Santa Clara County is the hottest marketplace, the fastest paced. You can see that Central Valley and the North Bay are basically right on, giving Santa Clara County a run for their money. The other areas are slower, but still doing fairly aggressive for where they typically are. So you can see this is a widespread, fast-paced marketplace. Time on the marketplace, again, Santa Clara County, Silicon Valley is typically the fastest, and it is the fastest overall. And, it's 16 days. Your other areas are quite a bit slower, but that's basically where they are. And I think this is a pretty reasonable benchmark. It's how long it takes the typical seller, the 75th percentile seller, to sell their property. But being able to sell in all these areas in basically a month or less is still fairly quickly. Here is your price reductions, and I've talked about this, having these numbers, these two numbers here are so close together. I don't know where the significant digits change, but, you have 3 data points here with 3 numbers, and you can actually see the top number is shaded a little bit. So all the way up to the 2. So for 4 places, it's this same number, and it changes after that. But you can see there's not much shift, but being able to see that this shift happened earlier, I think, is very valuable. Here's the frequency of price reductions from the seller, and you can see that basically before the first of the year, because this is the first of the year, before the first of the year, we started having fewer price reductions. Here's the Greater Bay Area, sale price to list price magnitude. You can see the areas, Silicon Valley and the cities, San Francisco doing the highest, up here at 106%, followed by North Bay. It's pretty self-explanatory. And again, I ran out of time, so I don't have the numbers on the balance of slides, I don't believe, and I will work on improving the automation so that the numbers are there for all the graphs going forward. Here's the overbid. And the takeaway is basically Silicon Valley and San Francisco areas are the hotter areas as far as when it comes to offers accepted and the aggressiveness of the buyers. Here's the frequency of overbidding, the same thing, pattern where the 2, Silicon Valley and San Francisco, outperform the other 3. And this is total appreciation. Now here it sort of shifts. San Francisco and Marin is by far the least amount of appreciation, and it basically happened with the pandemic. So people wanted to flee the city of San Francisco as soon as they didn't have to commute into it on a daily basis. And it's also noteworthy the area with the best appreciation is actually the Central Valley. And I think that's, again, because people can commute out to the San Joaquin County, Sacramento, and commute in. They also have, Mountain House, a fairly large development of new homes that are fairly expensive for where the Central Valley has historically been priced at. Here's the monthly payment, and I think I've got that on there 3 times, only meant twice. But again, you can see that the payments were going down as the market was slowing down, so it was not an interest rate driven market slowdown as many people allege and hypothesize, but I don't believe the data. I think the data refutes that pretty clearly. And with that, we are talking about week number 20. To get to the archive, you type in the green URL. To get to the live presentation, you add the purple at the end of that green URL, 2023, and you get to the presentation live on Saturday morning. If you want the handout, you put in H 2023-05-20, and it is posted. I only got it up about 5 minutes before the hour, and any specific episode, I'm open for any questions. Not seeing any questions. I'm Richard Calhoun with Creekside Realty. Appreciate any feedback and any improvements, because a lot of the improvements I've been doing have been coming from the viewers that are watching this remotely. So I appreciate any feedback and welcome more. What do you want me to address next? Because I think by next week I'll have this pretty well polished. With that, I'll say goodbye and have a great week. See everybody next week. Bye now.